Welcome to the Alternate View. Excited about our guest today. We have Greg Barger from NewSpring Capital, Mezzanine's team. So Greg, thank you for being here.
My pleasure.
Appreciate the time. Why don't you give us a little background of yourself and NewSpring Capital, and then we'll dive into talking about some mezzanine capital, which
Sure.
I'm excited about.
Yeah, absolutely. So NewSpring Capital is a 25 years young private equity firm. We're headquartered up in Radnor, Pennsylvania. We're currently a multi-strategy private equity group. So we have 5 different strategies underneath the NewSpring Capital umbrella, of which mezzanine is one of them. And actually, it's our largest strategy at this point, based on funds under management. Currently, as a firm, we have about $3 billion under management. And the mezzanine strategy, as I said, is about we're on our 5th fund. It's about a little over $1 billion under management in the mezzanine strategy.
Excellent.
Yeah.
And how about a little bit about what you do there?
Sure. So I'm one of the general partners of NewSpring Capital and the general partner of NewSpring Mezzanine. So I'm one of 4 other partners that lead the mezzanine strategy for the firm.
Great. Well, great. I'm looking forward to having a conversation about mezzanine capital. I feel like it doesn't get its due in the
always happy to get the word out
in the world of investing. I feel like people just like glaze over it. So it'll be good to have a conversation about it, and hopefully our listeners and watchers will be able to learn a little bit about mezzanine and what you guys are doing there. So first, I guess we should start off with what is mezzanine lending, and like how do you guys define it in the simplest terms, and what makes it unique relative to other lending components?
Yeah, sure. So mezzanine lending is a loan for the most part. Now, the way we're structured, we do both lending and equity investments under our mezzanine strategy. But essentially, mezzanine debt is the middle layer of the capital structure of a business, where you have senior debt as kind of the priority first lien. You have mezzanine debt, and then you have your equity. So we're kind of in the middle, and that's why it's somewhat of a hybrid between senior debt and pure equity.
Yep. And then who typically takes on the senior kind of portion of that? And then, why mezzanine? Where does that come into play? You guys are a private lender.
Sure.
To businesses, obviously, right?
Yeah.
So, why?
So the senior lenders are primarily that we would work with are the typical banks you'd see anywhere, where like a PNC, Bank of America, Wells Fargo, they're the senior lenders, and they have they're highly regulated businesses and banks. So the amount of lending they do is pretty restricted and pretty, I wouldn't say limited, but there's certain boundaries that they won't go beyond from a risk standpoint for a bank, and we kind of come in behind that. So it's a slightly more, because we're behind the senior lender, it's a slightly more risky piece of leverage. But on the flip side, it's also for the businesses that we do the mezzanine lending to, it's the ability not to dilute, not to have to raise equity if the bank's not going to do it. It prevents the dilution of the owners of those businesses somewhat, in a higher rate, a slightly higher risky debt piece. And
obviously, it's more costly for them, right?
Yeah.
So to an extent, right? But
exactly.
Why are these business owners looking? Well, why would they take a mezzanine slice? Obviously, senior lending, you're typically probably less expensive, right? You're dealing with the big firms and things like that, and then you guys are kind of that secondary private lender that's providing capital. Why, typically, like when we're lending to these businesses, why do they need a mezzanine slice in their business? Obviously, you mentioned limits to the senior lender, but what are they using it for, and like what is it?
Yeah, it's usually part of some sort of transitional transaction, whether it's generational change, it's someone just selling, maybe selling to the management team that's kind of running the business day to day, that doesn't have enough capital to do it on their own. But some of the advantages of it is, with a senior loan, you're typically personally guaranteeing, the owner's personally guaranteeing that debt, and frankly, when banks make a loan to you, they amortize it pretty quickly to get that money back. Mezzanine debt is much more, I would say, patient in terms of the capital. We charge, it's a higher interest rate, but it's interest only. We usually set some sort of a target in the future. It's typically 5 to 6 years for us where that debt would come due, and allows during that period for the business to be able to grow or the transaction to happen that they're trying to finance. So I see some of the benefits, like I said earlier, there's less, the owner's taking less dilution by having debt, but they're also likely not personally guaranteeing it, and they're not having to amortize it back. So when you do the pure cash out of the business, if you do the interest rate, even though ours is higher, but you combine it with the amortization on the senior debt side, and often, especially in an interest rate environment like we're in now, it's actually less costly to the business to use our form of financing as opposed to senior debt that's amortizing quickly.
Really?
Yeah.
That's interesting.
Yeah.
Now, so obviously, I mean, I think sometimes mezzanine might get a bad rap in terms of the quality of credit wise, right? This isn't the senior lender. People might think mezzanine is kind of a high yield type of investment as it relates to the to the public market.
Sure.
Is that a misconception?
Maybe somewhat. I would say, if you on a pure institutional basis, if you would take the debt instruments that we're lending, that would be considered high yield debt in the public markets. Yeah. But we're focused very much on the lower end of the middle market. So, companies 20 million to 150 million in revenues is kind of where we focused. And there's some really, really strong businesses there. But, the way the banking market's structured, there's just, they don't have a lot of flexibility in how much debt capital they can provide to those things. So, and we underwrite those businesses. Some of them, been around for decades, generations. They're really solid. They're just, it's a $50 million business, has been doing great, but it just doesn't fit the institutional category that you would think from a Wall Street type business. So
these are functional businesses generating revenue.
Absolutely.
Has a product or service that's actively participating in the marketplace. Yep. This isn't someone that's not generating revenue.
No. It's the largest. If you look at the U.S. number of U.S. businesses, privately held or publicly held, the category that we invest in is by far the largest category in terms of size. It's it's the things you're seeing, the little manufacturing operation in your neighborhood down the street that's been doing $30, $40, $50 million in revenues for 20 years.
Yeah, and what do they? I mean, you mentioned some transition. Do they use it for growth capital as well?
Yeah, absolutely.
Okay.
Yeah, it's often we get involved when there's some sort of either transition taking place or, there's the owner doesn't have family members or a management team that wants to take it over. He may be looking to private equity to sell the business. Yep. We may partner with a buyout firm where they're trying to buy the business, to put it with another one or continue to grow it. So we'll provide some of that capital for a structure like that. So it's usually some sort of transition or transaction or sale when we get involved.
Yeah. You mentioned small mid-market kind of participation.
Yeah.
Like that was your kind of niche in where
Yep.
you guys participate. Does transaction size matter? Size of business matter? I mean, are there bigger firms doing large mezzanine transactions? And then are there why do you think your small mid-market kind of component is beneficial to, I guess, investors or to you guys as you're looking to lend?
It's like I said, it's by far the largest market in the U.S. in terms of number of businesses of the kind of the size that we focus on, and that's that 20 to, call it 150, 200 million in revenues. That's by far the largest category, and it's because it's not because of that size. It's not the multi-billion-dollar company that's got full management teams and all kinds of institutional capital behind it. So they're very much sophisticated. So these are much less sophisticated businesses. So the opportunity to find undervalued businesses in this market, we feel is where we like to focus. It's not as competitive. So there's a lot more value add you can do to those businesses that don't have a full management team, so we help them kind of round out a management team. They may not have a great marketing programs. They're not used to going out and have defined business. So there's some of the kind of the management supplements we can provide to those type of businesses to kind of help professionalize them, and then it would they kind of graduate on to the next category, kind of that middle market, 500 million revenues in there. So
great. And do these businesses have kind of alternate solutions other than investing in mezzanine capital? Is is there any other way to go? Do they just have to give up equity or?
No, I mean, there's all kinds of different financing options out there.
Okay.
I think ours fits really well in the market that we focus on because, again, at that size, they're going to be capped out at what they can do from a senior lender standpoint, and a lot of them don't want to give up a lot of their equity yet. So if they can find that blend where maybe they are giving up a little bit of equity, but they still have control, but they still have the capital to be able to kind of execute their growth plan, it tends to be a really, really nice fit for those type of businesses.
Okay. Can you walk me through some a transaction a little bit, like structurally, like what does that look like? You mentioned interest rate.
Yeah,
right?
sure.
You mentioned a little piece of equity.
Yeah.
You mentioned interest, something, but give me an example. Like, tell me about like a recent transaction and how it was structured in terms of, how are you guys generating, a return for your investors?
Sure.
With the structure of a deal.
Actually, I'll give you an example. There was a I won't name names, but there was a company here in Baltimore, right off the Beltway.
Yep.
It was in the contract manufacturing space. It was two non-active owners that had owned it for about 10 years. They had bought it as an investment, didn't really know the business that well. They hired a really strong operator to help them run the business. He got it on track and we're helping it to grow again. They wanted to retire out of the business. So they went to a local investment banker here in Baltimore to try to raise capital. So they came to us. We were one of the people they came to try to put together a structure to allow that operator to buy that business from them. So we put together a package where he actually personally invested almost a seven-figure number. We invested about, I want to say it was about $12 million in mezzanine debt and another $3 million in equity. And then the other owners had rolled some of their equity back into the deal. So we structured it. Basically the debt was a 5-year note. It was a 12% interest only, matured in 5.5 years, which was 6 months after the senior debt was brought in to do the transaction. He owned roughly, we owned just over 50% of that business because of the equity we put in. He owned a material amount as well. So helped him grow the business. We brought in, helped him hire a CFO. We brought in a business development person, together to help kind of expand out of more of a local market. We wound up, he found another buyer that wanted that business as an add-on to what they already had in the private equity space. So it was about a 6-year hold for us. We got the 12% interest rate for the duration. We had some warrants in it as well, so we benefited from the upside of that, and it wound up being for our investors it was slightly over on a combined basis between the debt and the equity invested. It was about a 3.5 times return over that 5.5 year period to our investors. So. Wow. Yeah,
that sounds fantastic. I mean, and seems like everyone worked out with that transaction.
It was. That was a very. That was kind of right down the middle for us. It was the typical split between the debt and equity we provide. I think the business was about $25 million in revenues, in maybe $3 million in EBITDA when we bought it. It was pushing 40 and almost $7 million in EBITDA when we sold it. So that's the kind of perfect scenario for us. We, over that 5-year period, if we can kind of double EBITDA, we're getting paid a nice 12%, as we go along in terms of the returns we're providing, and then we get the upside at the end. So it was, plus a 20%, over a 20% IRR, over a 3x return for our LPs.
Yeah, borrower's happy.
Everybody's happy. It worked out.
You guys are happy, right?
Yeah, it was good for everyone.
Is that typically what you see from a transaction at the end as well? I mean, are they usually a sale that takes place at the end of it, or are they trying to recap you out at some point in time? You're not cheap, definitely not.
No,
right?
not at all. So that's actually one of the benefits of a mezzanine debt is that we don't have to have a sale transaction to the exit out of a business. So if they kind of execute on the plan that we go in with, they can recap us out for lower cost debt.
Yep.
And that may happen before the end of our holding period. So it's often where, 3 or 4 years into a deal, they're hitting their plan, they're doing well, and then they have that capability to use the senior debt. They'll pay that piece off. We typically would have some sort of equity component to our investment, and that would happen either in the next transaction, whether that was a sale, or they continue to do well and we'll negotiate a buyout buy out of our equity, and we're done. So yeah. So
you
again, a win-win.
Yeah, it seems like you have much more flexibility than a traditional like private equity transaction,
Exactly.
where you're kind of like, hey, bought it at this price. Really do a lot of the same components that you guys are doing from a business perspective, in terms of helping them try to grow EBITDA, like help management teams, but they kind of need a financial exit transaction.
They need a transaction,
right?
Yeah.
Like where you guys have motivation to that underlying business to be like, hey, get rid of me at some point in time just because we're costly.
That's exactly
to some extent.
Yeah, and I mean that's what I see as the beauty of Mezz is that we don't have to have that kind of sale transaction to get our return and to be able to execute the plan. So, and there's often times where even if it's not a recap, they're generating enough cash where they'll just start paying us back in chunks, and they're allowed to do it, and that's great. And
so they just pay down principal.
They just pay it down with excess cash. So, yeah.
Oh, okay, great.
Yeah.
Well, I mean, since we're talking like debt in general, it's interest rates. Obviously, we've had a very big movement from a market perspective over the last couple of years here. Like, how does that impact you guys? I mean, you guys provide an interest rate to the underlying investor. Like, is it fixed? Is it floating? Like, what are some of those impacts to that? And I'm going to lead you a little bit. Like, what is mezzanine's floor? Like, is there a floor to mezzanine, or does it, is there, how high can it necessarily go?
It's interesting. Over the last, and I've been in doing this similar stuff for the last 20 plus years, our band of interest rates in the structure of our debt has been very narrow. Yeah. And it's kind of run in the 11 to 14% range on a current pay basis for us. So it does fluctuate. But I would say, and I kind of touched on it a little bit earlier, the rising interest rate environment that we've had recently has really actually been a benefit to us, because we're kind of still in that 12, 14% range, but the senior debt's gone, almost double it, if you look at it over the last couple of years. So when you add that additional senior, the rate from the senior debt plus their amortization, the actual cost of the business winds up being higher than that kind of 12, 13% coupon they're paying to us. So we tend to benefit in a situation like that, where if you look at the cap stack and maybe senior lenders were kind of doing 2 times, EBITDA.
Yep.
They start to pull back, or not as competitive when their interest rate environment is rising. So we actually typically move up in the capital stack, and it's a more opportunity for us to be higher in that capital stack, but still get that kind of same, 12 to 14% coupon. So the rising interest rate environment makes us more competitive, and we typically can see stronger credits at kind of similar pricing that we would historically do.
That's pretty fantastic.
It can be.
I mean, it makes it easier for you, right? Like,
I mean, I would say senior lending is probably out. There's obviously a lot of mezzanine funds out there that focus on our space, but I would say, where we see more opportunity is when senior banks start to pull back or have their interest rate spreads are starting to go the opposite on them. That's when we see more and more business, because it's, from a business owner, it's a more viable financing strategy, and we're much more patient capital, to be honest.
Yeah, I mean, and we've seen we've had this on other podcasts, but we've talked about the shrinking regional bank component of them lending.
Absolutely.
So I can see that being a benefit to you guys as you guys look as a subordinate lender alongside of a senior to provide more to that to help them support their business and their lending.
Yeah, no, absolutely. That's, and I came from I was at a mercantile bank here in Baltimore, which was a solid regional, bank, and those banks are going away. And so the large, multinational banks that, that are left, they're too large to be able to overly focus on kind of the local smaller markets. And they basically, that's more of a kind of check the box. If it fits, they do it. If it doesn't, it doesn't. Whereas, those regional banks that were more interactive with their business owners, they're going by the wayside, or there's less and less of them. Yeah.
How do these businesses necessarily find you guys? Right. You just mentioned there's a variety of other mezzanine lenders out there.
Yeah.
I mean, and you guys lend to a variety of different businesses in a variety of different sectors, and across the country here in the United States. So how are they finding you and you finding them?
Yeah. So our firm, or our mezzanine strategy, we're what's called an SBIC, a small business investment company. Yeah. So that is it's a licensing process you go through. It's under the Small Business Administration. So So a lot of the businesses that are looking for financing capital, they go right to the SBA website, and there's a list of SBICs that are right on that website. So that it could be as simple as that, or there's usually some sort of there could be, if there's a transaction taking place, it would be an investment banker that's that we interact with a lot, obviously, and they may be bringing them to us as, in terms of a capital provider that may be helpful for what the business owner is trying to execute.
Right. So you brought it up, SBIC, right? Like, I find that to be a very unique structure, and not everyone does it, which makes it even more unique in my mind. So everyone's not willing to become an SBIC lender necessarily, especially in the mezzanine space. Like, why did you guys feel like that was a route to go down?
Sure.
And explain a little bit more about what that means. And we could talk a little bit about SBA as well, Small Business Administration, like what, because that's all, I feel like it's all combined, right? It really is.
Sure.
They're matching businesses with SBIC components, and then you're borrowing from the Small Business Administration. So we consider that kind of like leverage. So let's talk a little bit about all of that. I think it's super interesting. First, why you guys thought that, as a lender, the SBIC route is the structure necessarily to go, and what are the benefits to you guys as a firm. So I think there's a lot around SBIC. There's a lot, there is. So I have plenty of questions around that, so we can keep on going about that, but I'll let you go.
Sure, So that's a big subject. So SBIC is, as I said, it's the acronym for a Small Business Investment Company.
Yep.
So it is a public-private partnership. It's actually, I think it's one of the, and I'm biased obviously, but I think it's been one of the most successful public-private partnerships in our country. I mean, I think the program was started back in the 1950s, and it's under the SBA. It's a government backed program where we have a licensed SBIC, and I'll go through kind of the process of getting there, has access to, and there's a lot of regs around it, but it's essentially you have access to 10-year Treasury priced capital as almost a 2-to-1, depending on the size of the fund, kind of a 2-to-1 leverage. You can use that capital to draw down to invest in the small business.
So $1 to equal 2, basically.
Exactly.
So you can lend, $2 versus the $1 you put up.
Exactly. So if we'll go out and raise a fund of $100 million.
Yep.
We'd have an additional $200 million access through the SBA to invest in. So it's from our standpoint, it leaves a smaller pool of capital that you have to raise from the private sector. To get access to more capital, to have a slightly larger fund so you can deploy more. Yep. But from the investor, the LP standpoint, they have a priority in that return, but all they're getting back is the 10-year rate and some fees around it. So it runs 3.5. It's been running 3.5 to 5% for us for most of our funds. We pay that debt back at that rate. Then all the upside, if we're returning kind of high teens in most of our deals to low 20% IRRs, only that 4.5-5% comes off. So the benefit of that extra $2 that was invested goes to our LPs on their $1 they invested. So it's really a win-win for everybody. Honestly, it really is. So that's the benefit of the program. That's why we and all of our funds have been SBICs from the beginning. So. And it's it's a very rigorous and vetting process. So you go through pretty in-depth review, audit process just to get the license. You have regular quarterly reporting as part of it. There's a pretty heavy regulatory burden, if that's the right word, probably not, but that you have to make sure you're maintaining in terms of how you're doing business. You're following all the rules, all the regs. It's audited regularly, so there's a lot of additional work around that you need to do. But on the financial side, I think for the business owners and for the LPs and for us, it's a real win.
So do you think that's why some other folks don't do that is because of all those regulatory components to get that done?
Yeah, I think that's part of it. The other part is that, a lot of, we're in the lower middle market.
Yeah.
The whole basis for the SBIC program starting was to focus on smaller businesses. So some of the regs are around the size of the businesses that we can invest in. Yep. It's what we like to do. It's the area of the market we focus on anyhow, so it really never impacts us because they're the size businesses we're always looking at. But there's certain people that want to they just want to be bigger funds and invest in bigger businesses. So they wouldn't do it for that reason alone, just because regulatory wise you can't, there's a cap to the size businesses you can put money into. Well,
I mean, from an LP standard, we love the fact that, you guys are an SBIC. Number one, you have a government entity regulating you guys to some extent. So, you have an extra kind of layer of eyes and due diligence. That we're covering a lot of things.
And our firm we have multiple layers because we're a multi-strategy and we have growth equity. And so we're, over $3 billion. So we're not only is the SBA a regulator for us, but we're SEC regulated as well. So we have a lot of regulation,
which is as a limited partner investor, right? You're like, okay, we have lots of people kind of looking.
There's a lot of people checking
make sure that things are going the right way.
We were literally just finished the SEC audit yesterday, but they just left.
Well, so congratulations on that one. So I guess I think the SBIC is very unique, and I think you're doing a service, number one, from the SBA side of things and lending to small businesses. I mean, small businesses kind of run this country, and they need the capital to grow, and so it's almost a good thing.
And it's amazing if you go look at some of the firms that started with an SBIC as their first investor, lead investor. Right? We're talking FedEx, Callaway Golf. I mean, there's some really well-known companies that they're first, and that's kind of what we love is we're doing that. That's what we're doing. We're starting the companies that are ultimately going to become like that. They're starting with us. We're the kind of that first institutional level of capital that they have access to.
Okay. Now, I'm going to go to the other direction of this and say, okay, well, that's great, but you're adding leverage, right? And leverage turns both ways, ups and downs, right? Absolutely. So I want to make sure that everyone's aware of that. So do you find that being in SBIC adds additional risk to investors by having that leverage component to that, or do you just how do you guys look at that?
Yeah, I mean, look, anytime there's leverage, there's more risk. So that's that's just the bottom line. But we this is what we've always done. So there's additional having a levered fund if you're not kind of hitting that 8%, 7%, 8% return overall in your fund, it can start to work against you. Or based on what level of that capital is, the cost of that capital is. We've never had that. You're going to have some bad deals in every portfolio, and we do just like everybody else does. But I mean, for 20 plus years, we've been kind of net high teens and over 2x or about 2x return to our investors. So it's never impacted us in terms of. It's always been a benefit in terms of our, and we have very strict underwriting standards, and we know we're in an inefficient market, which is more risky, but it's also a lot more upside because it's an inefficient market, and we can provide a lot of value add to those companies to help them get through that period.
Yeah, it opens up opportunities. For you guys.
Absolutely.
So, what happens if you guys are borrowing money from the SBA to do a transaction and it's not a great transaction, right? Like, how does that affect with the SBA, and does that?
It's because it's all pooled capital, so it's not on a deal by deal basis; it's on a fund basis. Yep. So that's why, as I said, you're going to have a bad deal. It happens. If it's earlier in the fund, it's going to it impacts slightly when you can start making distributions to your LP because you have to get over certain hurdle rates in terms of before you start distributing capital. So that's where the biggest effect would be the timing of when it would happen. But when it's all said and done, it's pooled capital, so it's really not on an individual basis. It's on the pooled capital basis. So we've never come close to even that being an issue.
Yeah, so diversified portfolio, like lots of different loans within inside of the portfolio. Yep. So if one impacts it, they're looking at it the total fund size.
Exactly.
And you guys have already.
We're typically kind of, I would say, we've averaged about 25 to 30 companies within a fund. So there's good diversification, and we're very conscious about industry diversification. Geographic diversification, so we're very conscious of making sure we're de-risking as best we can at every aspect.
Yep. So let's talk a little bit from an investor and LP perspective a little bit. So I look at your strategy, and you have a lot of different components to it, right? Like there's a debt component. You have kind of an equity component. Like, how do investors look at you guys as part of an investment, right? I mean, because you can generate a pretty good return from your equity warrants or equity itself, but you're also generating an income component to it. So as an investor, how have you seen other people look at mezzanine as part of a strategy within a broader portfolio?
Yeah, that's actually been one of our hardest, from a fundraising standpoint, that's one of the hardest things we deal with in terms of talking with LPs, because like you said, there's some alternative investors that have very, very defined buckets in what they invest in. And we're not a pure debt investor, and we're not a pure equity investor. It's a blend, and that's what we like about it. We are showing we're generating the return to where it makes a lot of sense, and it's been very beneficial to our LPs. But that's probably the biggest hurdle we run into. We have, and it's more, it's the larger pensions that have huge alternative asset pools that typically are they struggle with the most in terms of. I got a debt bucket, I got a private debt bucket, I got a equity bucket, I got a venture capital bucket, and we don't fit neatly into a couple of those, so that's where we find the most difficulty. So that's something we've always had to deal with.
What do they typically put you in then? Do they create their own, or do they actually think hey, you guys are debt because you're on the cap stack?
It's usually within their debt, and we try to we try to build our portfolio that we kind of keep a roughly 70-30 debt equity split. Yeah. So, and now that we've been very consistent in doing that, I think especially the larger, kind of alternative investors have gotten more comfortable that this is what we do. We're sticking to our knitting. We're not trying to float one side or the other. We're very consistent, and we get a nice kind of current return on the bulk of the portfolio, and then on the back end, can be some really nice upside to the benefits the LPs. So,
I mean, when you're evaluating a business, a company, making that investment, how do you guys foresee it? Right? Is it you looking at it as debt? We want to provide this, we want our loan back, we want our interest, and the upside potential of warrants and equities is a call option?
Yeah. So,
are you blending it in? I think right. You know where I'm going.
I know where you go. Yeah. So I think for us, we're always looking at the downside. I said that's our first. What can go wrong here? That's kind of where we start, and then as we kind of get over that hurdle, then we kind of focus on, all right, where are we in the portfolio? Is it, if we know, and honestly, you can, as a portfolio is maturing, we typically may up our equity to kind of build to that 70-30 from the equity standpoint, knowing that we kind of had a pretty solid portfolio, we got a real solid portfolio here. We know we've got a good, kind of a good return baked in. We really like an equity story, so then we may start to, we may put a little more equity in something, later on in a fund, if that makes sense. So it's all about kind of building that portfolio. But when it's all said and done, that 70-30 split has kind of worked well for us, and that's kind of where we try to stay. And it's not going to be like that on every deal, but we may do an all debt deal, but we may do a 60-40 deal at some point down the road, if that makes sense.
No, definitely does. Yeah. So as an investor, cash flow wise, how do they consider? Is it are they going to receive income as distributions to them, or are they waiting for the end transaction? How does that kind of flow? It probably helps in terms of defining where you guys sit. As an investment.
So I think it's the cash flow early. So because especially early in a fund, if we can find some really solid debt deals that are generating good coupons for us right out of the bat, we come out of the J curve pretty quick. So if you get and we're fortunate to have, being on our fifth fund, we've always, as we go to the next fund, we always have a nice backlog of opportunities to be able to invest in when we first go into that fund. So, and we've gotten better each fund, and hopefully we'll continue to do so. And so that I think when investors see that we're coming out of the J curve and they can start to get distributions pretty quick. Which if you a typical equity fund, you're 4 or 5 years down the road before you're really seeing any kind of returns. Within 18 months, we're typically able to start to make some distributions, which I think goes a long way with certain investors.
Yeah, everyone kind of I use the term "get paid while you wait" kind of thing.
Exactly.
Right?
Yeah.
It's nice to get paid while you wait a little bit.
That's a good way to put it. Yeah.
And to kind of show the investment, and obviously the J curve is important. People understand it to some extent. They hate to see it, but the outcomes at the end of the day are pretty interesting. What does your investor base look like today? I mean, you mentioned pensions and things like that, but do you see firms like Vernon's Capital Advisors as investors, or is it primarily like larger institutions in that space?
So for as an SBIC, so I will say our largest, which is interesting because we talked about them a lot today. Our largest LP base are banks.
Yep.
And it is as part of the bank regulatory environment. The only thing banks can invest in and get CRA credit, investment credit, or SBICs. So banks are our largest pool of capital, and it's been a great relationship because we, a lot of the senior lenders that we work with on our on opportunities are our LPs. So so that's our biggest pool, and I would say our next is probably. So
is this like, it's great because you see the banks pulling back and things like that, but they're making investments into SBIC driven funds. Is this like? I mean, is this regulatory capital for them? Is it their personal? Like, why are they investing with you guys?
They get CRA credits,
so they're getting credit.
They get CRA credit.
And they can generate a higher degree of return relative to that.
It's by far, and having been on that side, it's by far. Banks get CRA credits for various things, whether it's inner city housing, different. SBIC investments are one of the things they get CRA credits for. It is by far the highest returning investment they make. Not even close.
Yeah, I know. I mean, I'm sure everything else is kind of very low in terms of the return and risk spectrum to that. This is obviously, we talked about this hybrid type of solution where you can get some equity components to that, where you're generating you mentioned some pretty
and it's honestly it's a win-win because we, not only do they get a nice return on their investment. We interact a lot in terms of getting them opportunities to provide senior lending to.
Yep.
As same, and we get a lot from our senior lenders as well. They get a lot of deposit balances, not only from us but from our portfolio companies and things like that. They provide lines of credit to the firm. They could for different capital call lines and things like that. So it's really been a win-win situation between kind of our bank LP partners and ourselves. It's worked well.
So during this environment, I got to ask anyways, like, have they been upping their, or trying to up their allocations, or looking for more, like, relative to what they have done historically in the past?
We haven't seen any,
Okay.
And again, we raised Fund 5 2.5 years ago. It was kind of right at the tip of when things were starting to, so we haven't seen anything, but we'll see. We'll see in the next fundraising cycle if there's any change there. But.
So who's some of the other ones? I interrupted you on the bank side. I couldn't help myself, but who are some of the other type of investors?
For us, we one thing we do, not only do we try to diversify in terms of our portfolio companies, we also want to diversify with our LP base.
Yeah.
So I would say firms like Verdant's have become a very good option for us, and hopefully it's a good option for Verdant's and your clients. But so that those investment management firms are a strong category. We do see decent amount from insurance companies and pensions would probably be the next two in our strategy. Our other private equity strategies are slightly different in terms of who their LP space. I would say, I'll give an example. Our healthcare group is very, they have a lot more strategic investors.
Interesting.
Whereas our growth equity group is probably more traditional pensions and things like that. So it kind of varies between all of our strategies. But for the mezzanine strategy, banks are number one. I say investment managers are probably two, and then high net worth individuals / traditional pensions and things are probably the next largest category.
Great. Now, so. I mean, we've talked about it a little bit, but I'll wrap up a little bit with this. Just from an investment return perspective, like, we've talked about cash flows. We've talked about kind of equity warrants or direct equity. Like, as investors, like, what's kind of traditional for mezzanine? Like, what should we expect?
We target a kind of a high teens net IRR to our LP base, and a 2x kind of return on capital. Is kind of what our goal is, and obviously we're always striving to do better than that, and we have. But if we feel like, especially if you put that up against other asset categories, I think it stands up pretty well, and we've been able to hit those numbers, and we'll continue to try to do so. So that's kind of our target. And on the portfolio basis, we underwrite similar. We kind of price between our mix of debt, equity. We're wouldn't be able to. We're always kind of looking at least a 3x in our equity, 1.75 in our debt. If we can kind of blend that together, that's kind of the formula.
Yep. Well, hopefully, we've educated our listeners and viewers a little bit about mezzanine and where it sits on the capital stack and the benefits associated to having a nice cash flow component to that, as well as that equity type of kicker. Yeah. And they learned a little bit about what the SBIC is and how it's how the SBA is working with that. So I appreciate
my pleasure.
All the time and spending some time with me.
Anytime.
Thank you very much.
My pleasure. Thanks, Matt.
All right.